Corporate finance practice problem using Excel. Dividend policy impact on price or stock value. Get ready, it's time to take our chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we're in the practice tab as opposed to the example tab. The example tab in essence being an answer key. We have the information on the left hand side. We're going to populate that into the blue area on the right hand side. Looking at our plan 1 and plan 2, we're going to be using our price of stock or dividend valuation model in order to do our calculations. We've seen this model in prior sections, so I'm not going to break it out component by component, but we will use this for our two comparisons. So the formula is going to be the dividend at the end of the first year divided by the required rate of return minus the constant growth rate in dividends. So we have the starting point in our data set. Dividends today are at $3. Required rate of return, we're saying, is the 9%. Again, if you want more detail on this formula, you could take a look at the prior section for that. And then we have the constant rate of growth in dividends, which is the assumption we're going to have in order to do our formula here, which is basically giving us the valuation of future cash flows to give us the value of the stock, or which would be reflected hopefully in the price of the stock. So plan 1, we got the dividends today increase. So we're saying the dividends we're going to increase to 3.5 immediately, $3.05. The required rate of return still at the 9%, and the constant growth rate we're going to say then is at the 4%, staying constant as we increase the dividend. But in plan 2, we're saying that the dividends today are at the $3, so remaining at the 3. The required rate of return is still at the 9%, and that then is going to say that the constant growth rate from that point is going to be increasing at the 5%. So plan 1, we have the change in the dividends today, growth rate remaining the same. Plan 2, we have the dividends changing and the growth rate then being higher than the original plan. So let's plug this stuff into our formula to take a look at the price or value that we will believe taking place given our formula, which is basically estimating the future cash flows of the dividends. So we're going to start off with the dividends at the end of the first year. So let's do our little calculation on that. So let's first think about the dividends today. So we're going to be picking that up down here. The dividends are at the 3.5, and then we got the 1 plus the constant growth rate. So let's pick that up. I'm going to say then we got the 1 plus the constant growth rate. I've indented that by going to the alignment indent. Let's indent this one to alignment and indent this one. So this is going to be 1 plus the growth rate, which is 4% for 104%. Let's also make this a decimal number group, adding a couple decimals here. So we're at the 3.5. This is going to be equal to 1 or 100% plus the growth rate, which we're saying is that 4%, to give us then, if we make that a percent, go into the number group, percentifying it, 104%. Then I'm going to go to the font group and underline, and that's going to give us the dividends. So we'll say dividend at end of first year. And let's indent that 2 times by going to the alignment, indent once again. We're going to pull that then to the outer column. That's going to, in essence, give us our numerator, which is going to be the 3.5 times the 104, making that a percent. Number group, percentifying it. I'm sorry, not making it a percent. Let's undo that. We want to add decimals, simply decimalizing it. So we got the 3.64, and then we want to take a look at the denominator, which I'll simply call the denominator here. Bottom line of our formula, we're going to take the required rate of return. So let's pick up the required rate of return, which is going to be the 9%, minus the constant growth rate, which we said was the 4%, minus the 4%. Let's percentify those two, selecting those two items. A numbers group, percentifying it. Going to underline, selecting the second one, font group and underline. We'll pull this into the outer column and call it the denominator. And that's going to be then equal to the 9 minus the 4, making that a percent by going to the number group, making it a percent at the 5%. Let's do some indentation, selecting these items, go into the alignment, indenting that, and then the denominator, alignment, indent that again. And that's going to give us our price of stock for plan 1, which is going to then be equal to the 3.64 divided by numerator over the denominator, 5%, 73. Let's add a couple decimals to that number group, couple decimals. So that's going to be the price plan 1. Let's underline here as well, font group and underline. Let's think about the valuation, given our valuation or price model for, this should be plan 2, plan number 2. So similar process. I'm going to make it a little bit smaller so we can see this on one page, hopefully. Can I do that without making it too small? Is that possible? Is that still, can you still see that? Okay, I'm going to assume there was a yes there. So we're going to say this is going to be similar kind of calculation. We could actually, pull over the numbers entirely by simply copying this down and then possibly formatting. So I'm going to grab the autofill. Should be the same calculation. Let's go ahead and copy that down, do our little indentations here. Or we could format it this way. We could select these items, then go to the clipboard, format painter, picking up just the formulas or the formatting, not the formulas, and putting that right there. And there's our calculation. And then we just need to pick up the new numbers, which is going to be 3 for the dividends. And then we have and this is plan 2. So then we have the 1 plus, so 1 plus, and we're picking up the 5 for the constant growth rate now, making that a percent by going to the number group and percentifying out. We are at 105, font group and underline. And this will give us the dividends at the end of year 1, which will be equal to the 3 times the 105%, the 1.05, making that a percent, number group, percentifying it. We're at I'm sorry, not percentifying that. We're just going to add some decimals there. We just need to decimalize it. Decimalized. And then we're going to take the required rate of return, which is going to be the 9 here, and making that a percent. Let's percentify that. And then we're going to say that the constant growth rate is at the 5 this time, making that a percent, number group, percentifying, font group, and underlining, subtracting that out. We got the 9 minus the 5, making that a percent, number group, percentizing it, underline, font group, and underline. The price at then, hold on a second. That's not what should have happened. Undo. This is the cell we want to be on. We got the 3.15 divided by the 4, and let's make that add a couple decimals, number group, couple decimals. So we're at then plan 1 at the valuation at the 72.80. That's where we basically increase the dividend here. And plan 2, where we're saying that the constant growth rate, so in other words, the increase of the dividend does not outweigh basically the constant growth rate going up, which would be in plan 2. So in plan 2, we have the higher price, which we would assume, the valuation or price for plan 2, given the fact that we have this plan of a constant growth rate that is higher, even though we had not yet increased the dividend. Whereas plan 1, we increased the dividend, but did not increase the growth rate.